On the 4th of October, Zee and Sony had finally received the much-awaited approval for their merger from the Competition Commission of India, or CCI as we know it. This brings a major sigh of relief as the CCI approval is usually the primary hurdle and takes a little longer. However, the approval comes with certain conditions to be fulfilled by both Zee and Sony. Prior to receiving a CCI nod, concerns were cited towards the merged entity's market dominance in TV viewership, high fee from advertising, and on the channel pricing. Both Zee and Sony had made some voluntary submissions to the competition watchdog, which could include the closure of some channels. And post receiving a satisfactory revert from Zee and Sony, the Competition Commission of India gave a go-ahead. Now let's see how the merged entity would look like. In terms of TV viewership share, Zee and Sony will have 26%, which is to be compared with Disney and Star viewership of about 20%. In terms of digital market though, the Zee-Sony combined entity have an advertising revenue market share of about 6% and subscription revenue market share of 18%, which is anyways lower than Disney and Star of 18% and 25% respectively. Zee's current shareholding pattern has a promoter group stake of 4%, while the remaining is publicly held. However, post-merger, Sony is expected to hold a majority stake of about 51%, while Zee promoters continue with a little less than 4%. And other shareholders, including Oppenheimer, will hold 45%. Mr. Puneet Goenka from Zee will be the MD and CEO, while majority of the board of directors of the combined company will be nominated by the Sony Group. And the new entity will now have a quite complementary TV network, 2 OTT platforms, which is ZEE5 and Sony Live, 2 film studios, and a vast library of programs. In terms of the existing OTT platform offerings that both companies have, the total subscriber base for ZEE5 plus Sony would stand at 21 million, next only to Disney Hotstar. Notably, the merged entity will have a total cash balance of $1.5 billion and the ability to gain from synergies in advertising and distribution and cost savings on content, employees and marketing. While there are some approvals which are still pending from the shareholders, income tax, Ministry of Information and Broadcasting and ROC, the analyst community don't see these as big hurdles and find the current valuation of 15 times FY24 expected earnings as attractive.